Okay, so you want to own a corporate office building, buy a tower, fill it with companies, watch the rent checks roll in every single month without interruption. A 20-story building in a downtown core, hundreds of desks, thousands of employees walking through the lobby every single morning, and every square foot of it renting for a premium price. That's the picture in your head. Walk past any major office tower on a weekday morning, and it looks like one of the most stable businesses imaginable. People in suits streaming through revolving doors, elevators packed, a coffee cart doing brisk business in the lobby. You watch that scene and you think, this building must be printing money quietly, year after year, forever. Here's the problem. You are looking at a snapshot of a business model that changed permanently within the last few years, and most of the mental math people still use to value an office building was built for a world that no longer exists. The truth is that a commercial office building is not really a real estate business in the simple sense. It is a long-duration bet on corporate headcount, corporate confidence, and corporate willingness to pay for physical space that, for a growing number of companies, has become optional rather than essential. And once you understand that shift, everything about why some office towers are thriving and others are quietly becoming worthless starts to make sense. Let's start with what it costs just to get into this business. There isn't one type of office building. There are several tiers, and the tier you buy into determines almost everything else about the economics. A Class A building is the kind with a prestigious address, a recently renovated lobby, modern climate control, fast elevators, and often a name-brand architect behind it, commanding the highest rents in the market and attracting law firms, financial institutions, and corporate headquarters willing to pay for the image that comes with the address. A Class B building is older, still functional, still professionally managed, but without the prestige finishes, and it rents at a meaningful discount to Class A space in the same submarket. A Class C building is the oldest tier, often decades past its last major renovation, competing purely on price, usually filled with smaller tenants who can't afford anything else. And then there's a category that barely existed 20 years ago and now defines a huge slice of the market, flexible or co-working space, where an operator leases an entire floor from a landlord and then re-rents individual desks and suites to smaller companies on short-term, flexible terms. Each of these tiers is a different bet on the same underlying question. Are you betting on prestige tenants who sign long, stable leases, or are you betting on volume and flexibility from smaller tenants who can leave far more easily? Now here's where the naive mental model starts to break down. You think the expensive part is buying the building. It isn't, not entirely. A large downtown office tower can easily run into the hundreds of millions of dollars just for the acquisition, but that number is only the entry fee. The real cost that catches new owners off guard is what the industry calls tenant improvement allowance, or TI. When a new tenant signs a lease, they almost never move into a bare shell. They want the space built out to their exact specifications, walls in specific places, particular flooring, kitchen areas, conference rooms wired for their systems. And in most markets, the landlord is the one who pays for a significant portion of that build-out as an incentive to win the lease. In a competitive downtown market, tenant improvement allowances can run anywhere from $50 to $150 per square foot, sometimes higher for premium tenants in a soft market. On a 20,000 square foot lease, that can mean writing a check for $1 to $3 million before the tenant has paid a single month of rent. And here's the part that makes it genuinely risky. That build-out is customized to one specific tenant. If they leave in 5 or 7 years, much of that investment is effectively gone, and you're paying to rebuild the space again for whoever comes next. On top of the improvement allowance, most competitive office leases also include what's called a leasing commission, paid to the broker who brought the tenant, typically 4 to 6% of the total lease value over its full term. On a 10-year lease worth several $1,000,000 in cumulative rent, that commission alone can run into the hundreds of thousands of dollars, paid up front before the building has collected meaningful revenue from that tenant. Add architectural and engineering fees for designing the build-out, permitting costs, and often several months of free rent offered as an additional incentive to close a competitive deal, and the true cost of signing a single major tenant can be a genuinely enormous number before that tenant has contributed a dollar toward your bottom line. In a soft leasing market where several competing buildings nearby are all chasing the same shrinking pool of prospective tenants, these incentive packages tend to escalate further because landlords compete on generosity rather than headline rent, offering ever larger improvement allowances and longer free rent periods just to win a signature on a lease, which quietly erodes the effective rent the building actually collects over the life of that lease, even when the advertised asking rent on paper looks unchanged. Now let's talk about how the lease itself is structured, because this is where office economics get genuinely different from a building like an apartment complex or a strip mall. Most large office leases are what's called triple net, meaning the tenant pays not just base rent, but their proportional share of property taxes, building insurance, and common area maintenance on top of it. This shifts a meaningful amount of the building's operating risk onto the tenant, which sounds like a great deal for the landlord until you remember that if the space sits vacant, the landlord absorbs all of those costs alone, with nobody sharing the burden. A large office tower with elevators running constantly, climate control conditioning enormous floor plates, and 24-hour security and cleaning staff can easily run operating costs of $15 to $25 per square foot per year. And every square foot that isn't leased is a square foot where the landlord is paying that bill entirely out of pocket while collecting zero rent to offset it. Here's the number that actually determines whether this whole business works: the capitalization rate, usually just called the cap rate. It's calculated by taking a building's annual net operating income and dividing it by the building's purchase price. And it tells you, in simple terms, the return you're earning on the money you put in before financing costs. In a strong market with high-quality tenants on long leases, a premium office tower might trade at a cap rate of 4 to 6%, meaning investors are willing to accept a relatively modest annual return because the income feels safe and predictable. In a weaker or riskier market, that same building might need to trade at a cap rate of 8 to 10% or higher to attract a buyer at all, which sounds like a better deal until you realize the higher cap rate exists specifically because the market believes the income is less safe. This single number, more than almost anything else in commercial real estate, is why two buildings generating identical rental income in the same year can sell for wildly different prices, purely because investors perceive one as carrying meaningfully more risk than the other going forward. And here's the mechanical relationship that catches new owners off guard. If a building's income stays exactly the same, but the market's required cap rate rises by even 2 percentage points, because confidence in office real estate has fallen, the building's actual sale value can drop by 20 to 30% without a single tenant changing anything about their lease. The building didn't get worse. The market's appetite for the risk changed, and that alone can wipe out years of appreciation on paper. Now here's a layer of expense that almost never shows up in the headline numbers people quote when discussing office real estate, the sheer cost of simply operating a large vertical building full of people every single day. A tower of any real size needs round-the-clock security staffing, a dedicated engineering team to keep elevators, fire systems, and climate control running without interruption, and a cleaning crew large enough to service every floor overnight without disrupting tenants during business hours. On top of that, insurance premiums for large commercial buildings have climbed sharply in recent years, driven by rising construction costs, more frequent severe weather events in many regions, and a general hardening of the commercial insurance market industry-wide. None of these costs shrink meaningfully just because a few floors sit empty. The elevators still need to run for the tenants who remain. The lobby still needs security overnight. The fixed cost of simply keeping a large vertical building operational doesn't scale down proportionally with occupancy the way a smaller single-story business might. The tenant mix inside a building also matters enormously to its long-term stability in ways that go beyond simple square footage. Law firms and financial institutions have historically been considered premium tenants precisely because their business models depend heavily on prestige addresses and in-person client meetings, making them less likely to fully abandon physical office space, even as other industries have embraced remote work aggressively. Technology companies, by contrast, were often among the earliest and most aggressive adopters of hybrid and remote arrangements, and buildings that leaned heavily on tech tenants during the previous decade's leasing boom have in many cases seen the sharpest reversals in demand as those same companies significantly downsized their real estate footprints during subsequent corporate cost-cutting cycles. A landlord who built their tenant roster around one industry's growth story can find that same concentration becomes a liability when that industry's real estate needs shift all at once. Now, the tenant relationship itself, because this is where the structural risk of the entire business actually lives. A large corporate tenant leasing an entire floor or multiple floors functions a lot like an anchor store in a shopping mall. Their presence anchors the building's reputation, their brand on the directory signals quality to other prospective tenants, and their long-term lease, often 7 to 15 years for a major corporate headquarters, provides the predictable income stream that lets the building get financed in the first place. But that same concentration creates enormous risk. If a single tenant occupies 30 or 40% of a building's leasable square footage and their business hits a rough patch, downsizes, or simply decides remote work has made a large physical footprint unnecessary, the landlord can lose a massive percentage of building income in a single lease decision, with very few replacement tenants of that size readily available to step in. And this brings us to the structural shift that has reshaped this entire industry over the past several years. More than any single factor in decades, arguably more than any shift the commercial real estate industry has faced since the rise of the suburban office park decades earlier, hybrid and remote work fundamentally changed how much physical space companies actually need. A company that once leased space for 1,000 employees at their desks every single day might now need meaningfully less square footage if a large share of that workforce is only in the office 2 or 3 days a week. Multiply that shift across an entire city's worth of corporate tenants simultaneously renewing their leases, and you get a phenomenon the industry now watches closely called the shadow vacancy problem, where a company is still paying rent on space. It signed years ago under the old assumptions, but is actively trying to sublease a significant portion of that space back onto the market because they simply don't need it anymore. This shadow supply doesn't always show up immediately in official vacancy statistics, but it quietly depresses the market for everyone because a tenant can often sublease that unused space at a lower rate than the building's own asking rent, undercutting the landlord's own leasing efforts in their own building. National office vacancy rates in major markets climb to levels not seen in decades following the shift to hybrid work, with some downtown cores seeing vacancy well above historical norms even years after the initial disruption. Because lease terms are long, and the full effect only shows up gradually as leases come up for renewal one at a time rather than all at once. This is the trap hiding inside long-term leases. A building can look financially healthy on paper for years, collecting steady rent from tenants who signed a decade ago, while the underlying demand for that space has already fundamentally weakened. The pain doesn't arrive all at once. It arrives lease renewal by lease renewal, as each tenant reconsiders how much space they actually need this time around, and often signs for significantly less than they occupied before. Most large office towers today, much like shopping malls, aren't owned the way an individual might own a house. They're owned through real estate investment trusts, publicly traded companies that pool together dozens or sometimes hundreds of properties and are legally required to pay out the vast majority of their profit to shareholders every year in exchange for favorable tax treatment. This structure lets an ordinary investor buy a small stake in a portfolio of office towers for the price of a single share, without ever personally dealing with a leaking roof or a departing anchor tenant, and it spreads the risk of any single building underperforming across a much larger collection of properties. But it's worth noting that this same structure means the value of these companies, and by extension the office towers they own, gets marked to market constantly by public investors, which means a shift in sentiment about the future of office work can move the value of these buildings in the eyes of the market long before any individual lease actually changes. Most public reporting on office real estate is aggregated across dozens or hundreds of buildings in a single portfolio, which can hide enormous variation between individual properties. A REIT might report a healthy blended occupancy rate across its entire portfolio, while several of its older, less amenity-rich buildings sit at 40 or 50% occupancy, dragged upward in the average by a handful of newer trophy properties performing exceptionally well. This is why two buildings on the same city block, built in different decades with different amenity packages, can have wildly different financial trajectories, even though from the sidewalk they might look like they're competing for the exact same tenants. Most large office leases, unlike gym memberships, don't come with a monthly opt-out for the tenant. Once signed, they're a binding legal commitment that a company genuinely cannot walk away from without significant financial consequences. But there's a related, quieter mechanism that has become increasingly important: the sublease market. A tenant who signed a 10-year lease for a full floor but only needs half of it can, in most leases, sublease the unused portion back to a third party, often at a discount to what the landlord is asking for comparable space elsewhere in the same building. This puts the original landlord in an unusual position, competing against their own tenant's unused space for the next prospective renter, and because the subleasing tenant is often motivated simply to offset some of their sunk cost rather than turn a profit, they can afford to underprice the landlord's own available space significantly, which drags down achievable rents for everyone in the building at once. A wave of major office buildings across multiple large American cities have gone through what the industry bluntly calls being handed back to the lender, where an owner who financed a building with a large loan simply stops making payments and lets the lender take the property, because the building's income no longer covers its debt, and the equity the owner originally put in has effectively been wiped out by the drop in the building's value. This has happened to office towers that were, on paper, fully respectable Class A properties in major downtown markets, purchased at valuations that assumed pre-pandemic occupancy, and pre-pandemic rents would simply continue indefinitely. When those assumptions broke, the debt used to finance the purchase didn't get any smaller, even though the building's income and its resale value both did. Billions of dollars of office debt across the country has come due during exactly this period of weakened demand and higher interest rates, forcing owners to refinance loans at valuations far below what they originally borrowed against, and in many cases, simply walking away rather than injecting new capital into a building worth less than what's owed on it. Now, the psychology behind why some companies keep paying for large offices they barely use, because the behavioral piece here matters just as much as the raw numbers. Part of it is that many corporate leases are long-term legal commitments signed years in advance, and breaking a lease early typically comes with severe financial penalties, sometimes requiring the tenant to pay the remaining rent owed on the entire lease term, regardless of whether they occupy the space. Part of it is cultural. Companies that built their identity around a prestigious headquarters address are often reluctant to be seen downsizing publicly, worried about what it signals to investors, clients, and employees about the company's confidence in its own future. And part of it is a genuine hedge against uncertainty. Executives who lived through the sudden, chaotic scramble of the pandemic's early return to office period are often unwilling to give up space entirely, worried that mandating a full return in the future without adequate space to do it would create a much bigger operational headache than simply continuing to pay for space that currently sits half empty. The buildings that have adapted successfully share a common thread, and it isn't cutting rent, it's changing what the building actually offers. Instead of leasing bare floor plates and calling it a day, many office landlords have started investing heavily in what the industry calls building amenities. High-end fitness centers, conference and event spaces available to all tenants, upgraded lobbies designed to feel more like a hotel than a corporate building, on-site food and beverage options, and outdoor terraces. The logic is straightforward. If a company is going to convince employees to commute into an office at all in a world where working from home is a viable alternative, the office itself has to offer something meaningfully better than a spare bedroom. And buildings that can offer that experience are outperforming buildings that are simply floors and elevators, even when the underlying rent, square foot, looks similar on paper. There's also been a notable shift in how landlords structure new leases to manage this uncertainty. Shorter lease terms have become more common, with some tenants specifically negotiating for more flexibility to expand or contract their footprint as their workforce needs change, rather than locking into a rigid 10 or 15-year commitment the way corporate tenants once did almost automatically. This gives tenants exactly the flexibility they're looking for, but it creates a harder problem for landlords, because shorter leases mean more frequent turnover, more frequent tenant improvement spending, and less predictable long-term income to show potential lenders and buyers when it comes time to refinance or sell the building. So how does an office building actually make money in plain mechanical terms once you strip away all of this complexity? The core engine is straightforward. Total rental income across all leased floors, plus any additional income from parking, retail space on the ground floor, or amenity fees, minus operating costs, property taxes, insurance, and debt service on whatever loan was used to buy the building. If a mid-sized office tower generates $15 million a year in gross rental income, and operating costs including property tax and insurance run to $5 million a year, that leaves $10 million in net operating income before debt service. If the building was financed with a loan carrying an annual debt payment of $7 million, the owner is left with $3 million in actual cash flow, a real but relatively thin margin against a building likely worth well over $100 million. And here's the volatility that catches new owners off guard. If vacancy climbs from a comfortable 5% to a troubling 20%, and remaining tenants are only renewing at meaningfully lower rents than they paid before, that $10 million in net operating income can shrink dramatically, while the $7 million annual debt payment doesn't shrink by a single dollar because loan payments don't adjust downward just because a building's income did. Let's build out the two versions of a single year for this same building, because that's where the real risk of this business becomes clear. In the optimistic scenario, the building maintains occupancy above 90%. Existing tenants renew at rents equal to or higher than their previous lease. The building's amenity investments help it win a few new tenants relocating from older, less competitive buildings nearby. And cap rates in the broader market hold steady or compress slightly as investor confidence in office real estate stabilizes. Under those conditions, the building generates healthy, growing net operating income. comfortably covers its debt service, and its resale value holds or even appreciates modestly, a genuinely solid outcome for the capital and risk involved in owning a building like this. In the realistic scenario, a major tenant occupying a meaningful share of the building declines to renew their lease, choosing to consolidate into a smaller footprint elsewhere as part of a broader hybrid work strategy. Backfilling that space takes 18 months longer than projected because demand in the broader market is soft, and the new tenant who eventually signs negotiates a lower rent and demands a substantial tenant improvement allowance to make the move worthwhile. Meanwhile, cap rates across the market have risen because investor sentiment toward office real estate has weakened further, meaning even if the building's income eventually stabilizes, its resale value has fallen independent of anything the owner did wrong operationally. The difference between those two outcomes for the exact same building, in the exact same city, can run into tens of millions of dollars in value within a single refinancing cycle. And almost none of it shows up as one dramatic headline event on the day it happens. It's a slightly longer vacancy period here, a slightly more generous tenant improvement package there, a modestly higher cap rate applied by the market when the appraisal comes due, compounding quietly until the number the lender uses to value the building at refinancing time looks nothing like the number the original purchase price assumed. The lobby still gleams. The elevators still run on schedule. The security desk is still staffed every morning at the exact same hour it always has been. From the sidewalk, the good version of this building and the bad version of this building look completely identical because none of the difference lives in anything a passerby could actually see. And unlike a gym or a retail store, where a struggling location can simply reduce its footprint or renegotiate quickly, an office building's fortunes are tied to lease terms measured in years, which means both the good news and the bad news arrive slowly, gradually, one signed document at a time, long after the underlying shift that caused it actually happened. So if you ever find yourself dreaming about owning a corporate office tower, remember the one thing that actually determines whether you survive in this business. It was never really about how impressive the lobby looks or how many floors you can fill on paper today. It's about whether the companies signing those leases